Presumably, investors in equities were hoping that the lockdowns would be behind us and so on. But even before this virus, which suddenly broke cover in the last day, the Europeans were already locking down. Europe basically is going back into lockdown even before this happened. It's going to go down into lockdown even more.
This week's specials with Miles Franklin Precious Metal Investments. 1 ounce Canadian silver maple leafs for only $5.25 over spot. And 1,000 ounce silver bars for only $1.65 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a well-respected returning guest. Alasdair MacLeod is the head of research at goldmoney.com. He joins us this Friday, November 26, 2021. Alasdair, thanks for coming back on.
That's very much my pleasure, DK.
Whenever we put out a call for questions ahead of your arrival, we're flooded with all kinds of interest in your perspectives, your views, your outlook, your analysis on more topics than we'll ever have a chance of taking a crack at today. So I'm going to narrow it down to 3 primarily. 1, the most recent market drop and what it signifies as part of a much bigger pattern, and whether you think that that's going to be able to persist following the end of the year with Basel III, net stable funds and all that. And secondly, the Turkish lira seems to be, the Turkish central bank seems to be losing control of the currency, and it's running away versus gold in particular. We'll put a chart up to help illustrate that and ask what you think that means, perhaps as a echoing of what might have happened to either Weimar Germany or any other hyperinflationary event, or as a precursor of what might be coming for more fiat currencies, and perhaps which ones might be on the vulnerable list. And then the big thing about your recent article that you just came out with about the ECB and the problems that they're going to be running into in the face of rising interest rates. So could you bring us back to the present day and this latest drop we've seen in metals prices, and tell us about what your view is of that, this particular occurrence, and what you think it signifies as part of a bigger picture?
Yeah, this is being recorded. I should say this is being recorded on Friday the 26th, and as we're speaking, I see that the Dow is off around about 1,000 points. When I look at the transport index, it's down 4%, and the S&P 500 is down about 2.25%. So these are quite significant falls. The alleged reason for it is this new South African variant of the COVID virus. And that certainly is important because presumably investors in equities were hoping that the lockdowns would be behind us and so on. But even before this virus, which suddenly broke cover in the last day, the Europeans were already locking down. I mean, they were locking down in Austria. They were making vaccines mandatory, and the whole thing is Europe basically is going back into lockdown even before this happened. It's going to go down into lockdown even more. And of course, the British have reintroduced their red zones, which basically is going to screw the airlines and foreign travel and so on and so forth. So the whole thing is sort of coming back to where we were almost 2 years ago. Now, I don't think that the British are going to go into lockdowns. That I just don't see. The economic consequences are really, really awful. I mean, it's all very well for us in our ivory towers, whether it's, we're in a city or in Wall Street or something like that. But the effect on small traders, small and medium-sized businesses, which are 80% of any industry, any country, is absolutely catastrophic. And this is something that we just can't gloss over. So in that sense, I'm not surprised to see equities falling very, very heavily. It's extended into gold. Gold has got a slightly different story because we're coming up to this Basel III net stable funding ratio regulations coming in London at the end of this year. That's only 5 weeks away. And there is no doubt that as gold began to run away above 1800 last week, in the last 2 weeks, I should say, the effect has been for open interest on COMEX to expand extremely rapidly. It went over 100,000 contracts. Now, over 60,000 of that has been clawed back by what appears to be a concerted attempt by the bullion banks to smother the futures market. And I mean, they were really in the hole for an awful lot of money. I would say that at one stage we were looking at net shorts for the swaps, which is the category in which most of these bullion banks lie, of around about $60 billion. Now, that's an enormous short position. It's the worst it has ever been, pretty much. So they had to get it done. They had to smash it before this, the sort of final date, as it were, under the Basel III net stable funding ratio started being implemented in London. And what have we got today? I mean, we've got a situation where, with a new virus, with governments who will respond to this without any doubt at all by accelerating money printing. Gold should be going up under these circumstances. No, what do? They sort of try and push the idea that, well, people are losing money elsewhere, so they're going to have to liquidate everything like gold and so on. So what we'll do is we'll hit the gold price and people will actually begin to sell in the belief that others are selling. So gold price is back down under 1,800. I think it's currently trading, if I can just have a quick look at my screen, it's trading at 1,786. But in that case, I mean, we're looking at something which is specifically to do with the expiry of the December contract and the options around it. I mean, they want the call options basically to expire worthless and as many as possible. And that does mean keeping it below 1,800. So as this one runs off the board, bulls of the gold market might take some comfort from the fact that in recent years, very often the start of a good run has been December. So that could well happen again. I think it probably will happen. So on that basis, I think we can regard gold, if you like, as a special situation in the current environment, and silver for that matter. But looking at the market as a whole, there is the problem that as far as equities are concerned, you're going to be losing potential earnings for large swathes of industry. It doesn't seem to be as yet affecting the yields on bonds. They seem to have eased. I mean, the mantra being that, we're going to go back into recession sort of thing. But that is a nasty situation, and I'm sure we'll come on to it later. But the fact of the matter is that none of these central banks can really afford to see interest rates rise, because they are concerned that we're all going into a recession. Now, it doesn't matter what prices are doing. If prices are rising, they are at the moment. You've got inflation, and it's not transient. That is going to continue. It's actually driven not by logistic foul-ups and all the rest of it. Is actually driven by the fact that they've been printing money in huge quantities in recent years, and particularly since March last year. So that is what's fueling all the price rises. And we've got massive rises, which will be passed through by industry into the consumer prices. I mean, if I look at Germany's producer price index last month was shown to be up over 18% on a year ago. So how is that going to translate into the situation in Germany? There will be fewer goods sold because industry is not going to, produce goods on the basis of those huge, great extra costs, all the logistic problems and all the rest of it. I mean, you're going to find the product is not supplied into the consumer market. So the consumers will find that, they may be slightly more cautious about their spending, but what they buy they will chase up because there is less of it to chase up. So it's a nasty situation. And it's not just Europe. It is also exactly the same in America. It is exactly the same in the UK. And it is exactly the same in Japan. So these markets, to my mind, should be a lot lower. I mean, I'm talking about equities. The only thing that's fueling equities, of course, is all the money that's being pumped into them by central banks. I mean, you've got QE in America running at, it's now 100 billion a month, or a bit over 100 billion a month from December, theoretically being reduced by 15 billion. And it's going to be reduced every month by 15 billion. But will it? I mean, the whole point about QE is to keep financial assets inflated. At the moment that starts going pop, you can forget, you can forget tapering. That's just going to go out of the window. So, yeah, it's going to be interesting times. Happy Christmas, as they say.
In the face of that, when we spoke with John Williams from shadowstats.com, we've also got other analysts who are posting things talking about gold presaging or telling the truth about inflation before the government admits it, when the government is still denying it or downpedaling it or whatever. In this case, we have an example, and you've warned us about this for some time, is the frailty of the fiat currency system itself, and that there would be weak points that would exhibit. The country of Turkey right now, the Turkish lira, has been, one could call, strongly inflating or perhaps hyperinflating against gold for the past month or so. We'll put a chart up of that so people can take a look at that. But what is your view? For example, is the Turkish lira's run-up versus gold just an indicator of the weakness of that currency itself? And if so, is it mirroring what you've talked to us about in the past of the demise of fiat currencies? And is it presaging what we can expect to happen with other currencies, and which ones in particular might be the most vulnerable?
I think we should bear in mind that the Turkish lira has a long history of price inflation and monetary inflation. They knocked 6 zeros off the lira. I think it was in about 2002, 2003. It's around about then. 6 zeros were knocked off it. So what you're looking at is something that has already collapsed quite a long way. It's a continual collapse. It's rather like the Argentinian situation, where the currency just continues to go down and down and down and down. I think the thing that's interesting is Erdogan's instructions to the central bank to cut interest rates, not raise them. I mean, to my mind, there is a politician there who knows absolutely nothing about economics. He doesn't understand money. He doesn't understand currencies. He doesn't understand how fragile a currency is and how much it does depend on the public perception of its stability or lack of stability. And he's fueled it. I mean, he's fueled this fall. The thing that's interesting is that before we blame Erdogan solely for what's going on, I mean, I look at the knowledge or the lack of knowledge that politicians in other jurisdictions have about currencies and what actually, why they have their purchasing power. And I see this in President Biden, for example. I see this in leading figures in central banks. I mean, when I look at the ECB, I see this in Christine Lagarde. I mean, she's a lawyer. She's not an economist. But even if she was an economist, I think she'd be the wrong sort of economist. She wouldn't understand money in the original sense. She would understand it as a state-issued currency, which, of course, was what the Germans bought into before the First World War. This idea that the currency is actually the business of the state, not the business of the people. And it was George Knapp who wrote the book, The State Theory of Currency. Of course, the Prussians took this as, a sort of, confirmation of what they wanted to believe in anyway. And they tried to finance the First World War entirely by printing marks. And, they suspended the gold convertibility on the eve of the war. But it's amazing when you think that they were rearming themselves before the First World War, printing money, but still exchanging marks for gold marks when required. It just shows how slow the public can be on picking up on this. And of course, we know what happened to the mark after the war. But that is interesting. I think the point about the German inflation is that I think that the powers that be at that time felt they had no option but to pursue the monetary policies they did. The difference, I think, with Erdogan is that he's not so much pursuing a monetary policy or a currency policy. What he is doing is he's, sort of takes, if you like, a sort of the quasi-religious view that interest, and remember, we're talking about in the Muslim world here, interest is usury and is not sanctioned, by Allah. So, he's against it on those grounds. And that is the full justification, all that he needs to go and tell the central bank to stop charging interest. So you can see that there are fundamental differences. Nevertheless, his complete lack of understanding of the fragility of an unbacked paper currency, I think, is unfortunately echoed in the major central banks and in the political classes in the major jurisdictions as well. So it's happening to Turkey now. When things start cutting rough on the monetary front, I don't expect our politicians, our central bankers, to be that much more clued up than the situation we see in Turkey.
You recently wrote an article on the importance of and the pain that the European Central Bank, the ECB, will be experiencing if they, in a rising interest rate environment. Can you first explain why you see a rising interest rate environment in the cards? And secondly, how that will manifest itself in terms of real difficulties for the ECB?
Basically, the reason that we're going to get higher interest rates is because of the debauchment of the currencies. It's really as simple as that. If you're going to reduce the purchasing power of a currency, then anyone who's going to hold that currency is going to want compensation for holding it. And that is reflected in the income that he gets to compensate for the loss of purchasing power, which, of course, is interest. If you don't raise interest rates under those circumstances, then all that happens is that the purchasing power of the currency continues to slide. Now, this is not a matter of looking at the economy and saying, well, we're going into a recession, which basically means that prices are going to start falling, and falling prices are going to persuade people not to spend any money. And so you get a self-fulfilling prophecy and all the rest of it. This is the sort of Keynesian approach. What that misses completely is the reason that prices change. It is not because of economic activity, except in a marginal sense. It is because of the quantities of money, the changing quantities of money.
Currency.
Yeah, currencies. They always refer back to the Great Depression. It's that experience that really formed the education of people like Keynes as to how to deal with this current situation. They thought that the problem that we had in the Depression was falling prices, the result of gold as money. He wanted the flexibility to increase the quantity of currency to offset that so that this situation wouldn't occur. But it's a complete misdiagnosis of the problem, because the problem in the 1930s was caused by excessive expansion of bank credit and money in the 1920s, or currencies, I should say, in the 1920s. So it was a complete misdiagnosis, and we've got stuck on this stupidity ever since. The point behind it is that when you start losing the purchasing power of a currency because it is being diluted, or alternatively because people lose faith in it, I mean, those two things can happen. Then you have to raise interest rates. At least the central bankers think that the cure is to raise interest rates. In fact, the cure is to stop printing the stuff. It's actually a lot simpler than that. Stop printing the stuff and make it convertible into gold. That would cure the problem. But central bankers think, and the markets, because it's all populated by Keynesians, think that the answer is it can be managed through interest rates. So when you get a fall in the purchasing power of a currency, it is expected that the central banks will raise interest rates. And if they don't, the currency gets punished. So that is why we face higher interest rates. Whether or not we go into new lockdowns is completely immaterial. It's got nothing to do with it. The problem is the debasement of the currency. That is what will lead to higher interest rates. So if you look at the European situation, you've then got to ask yourself, how is that going to affect the financial stability of the euro? I mean, the answer basically is that you've got to look at the differences in the banking situation in the Eurozone compared with what we know in America. When I look at the large American banks, the globally systemically important banks, the G-SIBs, I see an average ratio perhaps of assets to equity of around about 10 times. Now, this is a little rich, but it's not excessively rich. However, when I make the same comparison in the Eurozone with the big Eurozone globally systemically important banks, I see an average level of somewhere between 20 and 30 times assets to equity. And to confirm the fragility of the situation, the share prices of all these banks are at a substantial discount to book value, which tells me that the markets regard these as a very risky investment. So that's the situation as far as the banks are concerned. They're very highly leveraged. Now imagine if you get rising interest rates. You've got two things that happen. The first is the effect on the assets that they hold and the mark-to-market values of those assets. Those assets are predominantly government bonds. Now, they've been encouraged into buying government bonds by regulations. The regulations make no distinction between first-class assets such as German government debt and Italian government debt. That is exactly the same as far as the Basel regulations are concerned. I mean, this is just crazy, absolutely crazy. So you can see that the first thing that's going to happen in a greater risk environment is people are going to start looking at these different banks from that point of view. What actually is the quality? We know what the regulations say, but what is actually the quality of the debt on their balance sheets? And I'm afraid that a lot of these banks, because they are national and because they support their own governments, you've got the makings of a banking crisis arising in the pigs, the Portugal, Italy, Greece and Spain, and possibly even in France. So, that's the first thing. The second problem is that there is a huge level of outstanding repos in this market. Now, we don't know the exact figure, but one of the industry bodies did a survey back in 2019 of 58 large repo counterparties and found the size of the market between those 58 alone, and admittedly they're the biggest, was around about 8.3 trillion euros. Now, for ease of reference, if you look at the reverse repos that the Fed was doing recently, we were all getting terribly excited when it went up to $1.3 trillion. We're talking about 8.3 trillion euros. And remember that the purchasing power of a euro in the foreign exchanges is higher than the dollar at the moment. I mean, that may well change. But we're talking about big numbers. That was in 2019. Now it is well over 10. That's my estimate. Well over $10 trillion. Now, if you look at the combined balance sheet of the euro system, which is comprised of the ECB and all the national central banks, that is around about 9 trillion euros. So what we're saying is that the repo market is bigger than the central banking system. Now, how did it get there? Well, it got there really through two things. Firstly, and I think most importantly, negative interest rates. The deposit rate, the ECB's deposit rate is minus half of 1%. Now, what this means is that you can do a repo with a central bank, and I don't know exactly what the repo rate is, but it will be based on that minus 0.5%. Now, if you were getting a negative interest rate on the cash side of a repo, then effectively you're getting, say, €1 million coming this way, and when you close the transaction, you only have to pay back €999,000. So you can see that this is, it's money for a rope, for goodness sake. Now let's look at the collateral side, because the whole point about a repo is you can get a lot of money into the bank by offering collateral. This is far bigger than the interbank market. The interbank market is unsecured. We're talking about a secured lending and borrowing system. So you look at the collateral. Now, what the local regulators have been doing, and this is very noticeable in Italy, is they've been looking at bad and doubtful debts on the banks and saying, well, yeah, for collateral purposes, we think these loans are performing. So that allows a bank which has got lots of bad and doubtful debts to push them into the euro system, like the Target 2 system, through the Banca d'Italia, the Italian central bank, in return for a cash. So the collateral, which doesn't appear on anyone's balance sheet, incidentally, collateral goes into the central bank, and euros come out this way. So you've got the impression that the Italian banks that are doing these repos are all, wonderfully, they've got all the liquidity, and it all looks lovely, and so on and so forth. But we're talking about a market, a repo market that has expanded. It's the largest in the world. I mean, it is just absolutely enormous. Now consider what happens when you get a rise in interest rates. You get a rise in interest rates, that market's going to start contracting. And when the repo market starts contracting, unlike the situation in America, where repos are just literally, about adjusting liquidity balances, what we're looking at is a wholesale reduction of bank liquidity and bank balance sheets. The contraction of bank credit we know as the other end of the bank credit cycle, and that is when everything starts turns turtle. That is how depressions come about, and we're going to get that situation arising when interest rates start going up in the Eurozone. Now, this explains, I think, in large measure, why it is that Christine Lagarde went on record, I think it was 2 weeks ago, saying that interest rates are not going to be raised in the Eurozone next year, full stop. No, they cannot afford to see any interest rate rises. So if you think this through, we've got a situation where eventually the market is going to force higher interest rates on currencies for the simple reason that they're losing purchasing power. And any central bank that can't meet this, and I'm not even, exploring the sort of territory which Paul Volcker went into back in 1980, but any bank that finds that any central bank that doesn't raise its interest rates on this market demand is just going to completely lose control over their monetary system and their currencies. So you will get a currency collapse. And this is, I think, this is very serious in the sense that, I would say when this happens rather than if this happens in the Eurozone, I think the political ramifications down the line are very serious indeed, because with the currency falling apart, with the whole system effectively bankrupt, with no currency circulating in the Eurozone, I can see huge political divisions building up, and I can see a lot of the old grievances, that we had from the Second World War and all the rest of it, all that sort of stuff, I think probably comes bubbling up to the surface again. I would be very worried about the long-term political implications of a currency collapse in the Eurozone. I don't say that about America, because America is I mean, you've got a different situation in America. The way I see it, and we've talked about this before, is I see a collapse, if you like, of financial asset values. I see a John Law situation whereby printing currency just to try and save the markets will actually destroy the currency. It won't even save the markets. The middle classes in America will be impoverished, and so on and so forth. But I think the difference with America is that Americans are immigrants or descended from immigrants. They have this thing in them sort of about freedom to get away from government control. And I don't think, that you've got fringe elements in America which don't speak for America. You've got this very, very large, stable, if you like, sort of silent majority who I think would look at a resolution of the problem very, very constructively. I just don't see that in Europe.
Back at the beginning of this scenario that you just described is the current regime of negative interest rates in Europe that's been driving this repo cash bonanza for countries like Italy, so on. Julian Bosman asks, aside from central banks, who is buying treasuries representing real losses and why?
Well, basically, it's the banks. The banks are buying these things. Also, you've got the establishment in the sense of insurance companies and pension funds. And you've got speculators on top. There's no doubt about it. A lot of this froth is provided by speculators who you always see at the top of a bubble. I'll give you an example as to why this is. If you want to hedge out of a falling currency, do you buy gold or do you buy Bitcoin? Now, if you're an investment manager, you've got a problem because gold is not a regulated investment. There are things which are related to gold which are a regulated investment. So you can go and buy mines or something like that, or you can buy futures which are regulated. That's fine. Bitcoin, you've got the same problem. You can't buy Bitcoin because they're not regulated, but you can now buy futures. So what are you going to do? The answer basically is if you want to keep your job, you have got to get that fund that you're responsible for performing measured in dollars. And the way you do that is you go where the money's going. You don't sort of sit there and theorize about, what is money? What is, what's real money? Is Bitcoin money? Can it ever be a currency? Can it ever say, that's for the fairies. If you're a practical investment manager, you've got the problem that you've got to get that fund performing. And if Bitcoin are running, you go and buy Bitcoin. And that is actually basically what's been happening in that market. So I would say that there is a lot of froth, which is obviously fueled by excessive quantities of newly minted currency going into the market. And it's not just QE, it's also stuff which is going into people's pockets, stimmies and all the rest of it, and they go and buy small amounts of this, small amounts of that. I heard a story today from one of my American friends who was telling me about some sort of Ford car which he had ordered, and a dealer offered him something like a 40% premium to buy it off him, over the new price, because if you want one of these cars, you've got to wait a year. And meanwhile, the demand is there. This is crazy. This is absolutely crazy. And of course, you've got the same thing in the housing market.
My wife and I are painfully aware of that one at the moment. Yeah. So this difference of decoupling, you also touched on this several times, the difference between physical prices versus needing futures, that sort of thing. Mike Smith asks, Alasdair, at what point do you think the price of gold on the Shanghai Gold Exchange may decouple from that on the COMEX?
Well, I think the way to look at that is, I think the way you prefaced it, the difference between the price for physical and the price for paper. I don't actually see them decoupling as such. I think what I would consider is, is it the paper or is it the physical that's driving the price? I think that's the better way to look at it, because there is no reason why they should decouple. except in the case where, let us say, there's a force majeure declared. I think that there are provisions for a force majeure on the futures market, but that is very much a last resort. You're not going to see the authorities declaring a force majeure just to, because there's a sort of, a problem which they can't find another solution to on the market. That is very much the last resort. It really is. London is interesting because you've got the forward market, obviously. I think that the way in which, if I was a bullion bank, the way I'd get out of my obligations in London is I would look at my obligations to depositors. I would then tell my depositors that, as of now, I cannot deliver gold against your unallocated account on request. I am closing unallocated accounts, and I will pay the balances as of yesterday, the valuation on gold yesterday. And you can continue to run the balances if you wish, but it won't be linked to gold. Job done. I think that's easy. I think that is an easy one to do because you're not talking about regulated investments. You're talking about a bank relationship with its customers. Now, customers may not like it, but you've got to understand that the bank is actually in the business of dealing in credit. It's not the business of dealing with money, dealing in credit. So it is going to vary the terms at its own disposal. And there is enough latitude, I think, in the standard LBMA contracts for a bullion bank to do that. The real problem, I think, in terms of decoupling, if I can just use that phrase, is going to be on COMEX. And as I say, I think it's very much a last resort for the CME to consider force majeure.
This is back to the topic that you've been touching on several times about the relationship between gold and other real things versus futures or fiat. Norsa Skrive says, in terms of gold, currency will, of course, plummet in value with both inflation and reset, but what about real things? Right now, I can buy a manufactured item like a car for the equivalent of 20 ounces of gold, but will its price in gold stay about the same even as the price in dollars skyrockets?
The answer to that, if we look at history and also if we look at economic theory, is that we can see the conditions of a currency collapse are one of impoverishing everybody. So you've got two forces at work here. You've got one at which you've got the purchasing power of the currency declining, being reflected in higher prices, whereas at the same time you have got the ability in real terms to pay prices declining. So in terms of what does you best, gold is, hoarded gold, physical gold will go up in value most, if you like, measured in currencies or against other assets. And I've told this story before on your show to illustrate the point. In Germany in 1923, you could have bought a house in a swanky part of Berlin, 6 bedrooms, all the rest of it, for the equivalent of 5 ounces of gold, $100. $100 at 20.67 dollars to the ounce is just a bit under 5 ounces of gold. Now, I don't know what the price in marks would be, but I think what you'd be looking at is a price, if you like, pre-war, which might have been 500,000 marks when it was tied to the gold mark, as it were, or I don't know, let's say 250,000 marks. By 1923, the price in paper marks would have been probably a few billion. So, yet the price in terms of gold fell from, let's say something like maybe 250,000 marks, gold marks, down to what would have been the equivalent of something like less than 100 gold marks. That is what happened. So the paper value of a property, a financial asset, or rather a fixed asset, the paper value goes up, but the real value measured in gold goes way down. So the best thing you can do is to have a store of gold and silver for that matter, for the conditions whereby this comes about, because you will be able to buy things which, at ridiculously low prices. I mean, I was telling someone the other day a story going back into the 70s, which taught me a huge lesson. We had one of our periodic oil crises, and it was a real panic. You know what market panics are like. Somebody I knew had an E-Type Jaguar, and he was prepared to sell it to me for £100. Now, that car nowadays would probably cost me about £70,000. If it was an ordinary E-Type rather than, let us say, one in concours condition. So you can see that the most silly thing I did was actually not to buy that car. Yeah. So that is the point. This is what happens when things really get nasty. In real terms, the value of these things just goes through the floor. But if you've got gold and silver, you're in a position to buy anything you want. And that, I think, is the great lesson. But you will also need it, don't forget. You'll need it for the essentials, rather than, let's say, running out and buying a large house or a nice fancy car off some poor fellow who can't afford to keep his car. You'll have to feed yourself. You'll have to pay for the energy to heat your house, whatever, or buy wood to burn in your fire. And more importantly, you'll have to help those around you, family, friends, close friends, and so on and so forth, because they won't have this. Unless you're so heartless that you're prepared to just stand by and hang on to your gold and tell them to go away, you're going to have enough to help these people. And I think that's a very, very serious point. Society may be falling about around you, but keep your bubble going as much as you can.
I would differ on one word choice in that previous treatise that you just did, and that was that the value of things hasn't changed. It's that the bid price can go ridiculously low during a panic. We saw that just about a year ago with crude oil going negative.
Yes, totally,
momentarily. The value might not have changed, but
sure.
the bid price.
I take the point. Yeah.
Yeah. We have a question here, and I think it's related from Ernest Como, and a reply from another viewer that I think will stimulate your response. The question is, what is to keep the criminals from manipulating metal prices for another 40 years? That certainly echoes a refrain from a lot of people who've been devoted accumulators of precious metals, is why do I have any reason to believe this isn't just going to go on ad infinitum? Ivailo says, this has been explained many, many times. After the paper currency loses value, in order to restore confidence, the bankers are forced to revalue the gold. This has happened many times in history. We are not the first to experience fiat collapse. They have no other options than to reboot the system. Even if they create a digital currency for the serfs, which they will, the central banks themselves must hold something of actual value that can't be manipulated. The simple answer is the Fed can't keep up the dollar Ponzi scheme another 40 years. Behind the scenes, they've already changed the system, although we serfs have been told it's a health crisis going on, just stay at home, shut up, and do what you're told. Tell us about your view of what reasons do you believe, and I think you've outlined that in many different aspects, but just to drive that home, why can't this suppression of illogically low metals prices on the futures exchanges be perpetuated for the indefinitely?
I mean, basically, what it requires for it to be perpetuated is purchasing power in paper currencies to be maintained to the point where its slide in purchasing power isn't actually noticed. And that, I think, is the thing that is likely to change. I mean, we've already seen M1 increase 400% from March 2020 to September this year. And, this is unprecedented in a major currency such as the dollar. It really is. So that is going to work through to prices. And we know what the central bank's response is going to be. It's going to try and sit on interest rates. And I tell you, the development of this new COVID variant just confirms that. They're going to sit on interest rates. We know that prices are going to continue to rise because it is as Milton Friedman said, it is the root of the problem is a monetary one. It is not a supply and demand one. So the ability of the system to sit on the gold price, the silver price, is copper price, anything you like, is going to be very severely restricted, and they're not going to be able to do it. And anyone who does this is going to, eventually turn around to the state and say, we need rescuing. And the state's going to turn around and say, well, yeah, fine, we'll print some more money and rescue you, which will just make the situation worse. So I think the answer is really the way you've got to look at it is that there's currencies losing purchasing power. It's not gold going up, it's currencies losing purchasing power. There will come a point where the loss of purchasing power in currencies will accelerate. And at that stage, you can say that the purchasing power of gold is rising and rising very, very sharply. So I think that's the way to look at it. It's this. I think I don't see that the situation which we've had this last week, where the bullion banks can come in and bash the gold price to close their positions on COMEX. I just don't see that continuing. I really don't. Not for very long. I mean, this could be the last time they do it.
Alasdair, for people who want to follow your work, which you publish weekly, where should they stay plugged in?
goldmoney.com. Hit the research tab. I do an article on every Thursday, which is like today. Today I've written about the Eurozone, which we were discussing earlier, and the relevance of the repo market. I do a market report on Fridays, which I've done today. It's a Friday that we're doing this. And while you're there, if you want to get yourself some protection from unfolding events, consider opening an account, because you can buy and sell gold, silver, platinum group metals. But I would specifically say you've got to start having some real money. And real money is gold, and its junior cousin, silver.
We've been speaking with Alasdair MacLeod. He is the head of research at goldmoney.com. Alasdair, I can never have you often enough on here, according to our viewers. They appreciate that, and as do I. Always learn something every single visit. Just thank you for joining us here on Liberty and Finance.
Very much my pleasure, DK.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.